Have you ever seen a fantastic economic report drop only to watch the stock market just tank? It is one of the most confusing things in all of finance. So today, we're going to pull back the curtain and explain the playbook that the institutional pros, the hedge funds and the big trading desks, use to read the news. It's a totally different way of thinking, and it all starts with a very, very common question. This right here, this is the classic. It trips up so many people, it just seems completely backward, doesn't it? You get amazing job numbers, and boom, the market sells off. Why does that happen? Well, the answer is in a framework that has nothing to do with just asking if news is good or bad. And this is probably the single most important idea to get your head around. Markets don't just see a headline and react. No, they filter every single new piece of information through what they already believed was going to happen, how traders are already positioned, and what it might force a central bank like the Fed to do next. Okay, so let's dive into the core of how the professionals actually think. It all really boils down to just one thing: the battle between what was expected to happen and what actually happened. The key term you absolutely have to know is priced in. It's just a fancy way of saying what the market as a whole already thinks is going to happen. See, before a single number is released, the consensus guess for that number is already baked into the current price of stocks, bonds, currencies, everything. So, and this is the crucial part, markets don't move because data is good or bad. They move because the data is different from what was expected. It's the surprise, that little gap between the actual number and the expected number, that forces everyone to reevaluate. If the actual number is exactly what everyone thought it would be, well, then nothing really needs to change. But here's the catch. Even a surprise isn't straightforward. As you can see here, if the actual number is stronger than expected, the reaction depends on something called positioning. For example, if literally everyone was already betting on a strong number, it can turn into a buy the rumor, sell the news situation, and the reaction is pretty meh. And if the number is weaker, well, that depends on if it fits the current market narrative, which is just the big story investors are telling themselves about the economy. All right, so if it's all about the surprise factor, which data points actually move the needle? Let's get into the professional playbook and see exactly how specific types of data get mapped to specific assets. First up, the big one: inflation. In today's world, this is the king of all data points. Why? Because it has the most direct influence on what the central banks are going to do. Here's the professional rule of thumb. Inflation doesn't move stocks directly. No, inflation moves interest rates, and interest rates move everything else, from the value of a high-flying tech stock to the price of gold. It's a chain reaction, and the very first domino to fall is always rates. So what are the pros glued to? The Consumer Price Index, or CPI, that's what we all pay for stuff. The Producer Price Index, PPI, that tracks costs for businesses. And then the really big one for policy, the Personal Consumption Expenditures, or PCE, which is the Federal Reserve's favorite inflation gauge. Next on the checklist is the labor market. This gives us a direct window into the real-time health of the economy, and of course, the consumer. But here's the thing, professionals don't just care about how many jobs were created. They care about what the central bank is going to do about it. This is called the reaction function. Is the job market so hot that the Fed has to hike rates to cool things down? Or is it so weak they might have to start cutting? That's the question the market is actually trading on. Yeah, the headline non-farm payrolls number gets all the media attention, but the pros, they're digging way deeper. They're watching the unemployment rate, how fast wages are growing, because that can fuel inflation. And they're even looking at weekly jobless claims to get the earliest possible signal on whether the labor market is tightening up or starting to loosen. And finally, we've got the data that measures the overall pace and momentum of the economy. Is the economic engine speeding up, or is it starting to slow down? This rate of change has a huge effect on which assets do best. When growth is picking up speed, investors love cyclical stocks. Think industrials, materials, small companies that do great in a strong economy. But when growth is slowing down, they run for safety in defensive areas, like healthcare and utilities, or into long-term bonds. So to get a read on this momentum, the pros are looking at forward-looking indicators like the PMI surveys, which are basically polls of business managers, along with hard data like retail sales and industrial production. Now here's where it all comes together. No single piece of data is ever analyzed in a bubble. The real pros put it all together. They use what's called a cross-asset confirmation filter to see if the whole story actually makes sense. Think of this as the ultimate sanity check. The pros are constantly asking,
Is the bond market confirming what the stock market is doing? Is the currency market telling the same story as both of them? If all the major markets are singing from the same hymn sheet, well, that's a high conviction signal. It's just much, much harder for all of them to be wrong at the same time.
Take a look at this. This is a classic, coherent signal. Imagine bond yields are falling, stocks are rallying hard, and the US dollar is getting weaker. All three of these markets are screaming the exact same thing. Financial conditions are getting easier, probably because the market is starting to bet that the central bank is about to cut interest rates. Now that is a story you can trust. So let's bring it all home. The next time you see the market just completely ignore some huge news headline, it's almost always for one of these reasons. 1. The news wasn't actually a surprise. 2. The move already happened before the news. 3. Everyone was already betting on it. Or sometimes, the market's internal plumbing, its structure and liquidity, just matters more than the headline on any given day. The ultimate takeaway from all of this is really about shifting your entire mental model away from how most people think about financial news. See, the amateur asks, is this data good or bad? It's a simple, intuitive question, but it's the wrong one. The professional asks something much more precise. Compared to what the market already believes, is this new piece of information significant enough to force a change in prices? And it is absolutely critical to understand that this framework is not a crystal ball. It's not about predicting the future with 100% certainty. It's about analyzing expectations, weighing different possible scenarios, and assessing how markets and policymakers are likely to react. It's a game of probabilities, not prophecies. In the end, understanding that difference, the difference between the amateur question and the professional question, between just reacting to a headline versus analyzing the surprise, that is everything. That difference is what the pros call alpha. It's the edge that drives performance.